Hey everybody, Matthew Pillmore here, president of VIP Financial Education. This is the VIP Financial Ed channel. Welcome back. Got a very special guest here today, a good friend of mine, Mr. Joseph Massey. Joseph is one of the most, I would say, sought after real estate mortgage professionals in the investment community here in Denver. And I've said this for years and years, if you want to be successful in real estate investing, you've got to link up with a professional that's in mortgages who specializes in real estate investing. So we're going to come back and touch on some of Joe's credentials here at the end of today's video. Make sure you stick around for that. But I would like to just kind of dig right into the content, Joe.
Yeah.
So Joe, you're going to be doing a couple hundred deals this year, right?
Yep.
Very close to it.
Yep, I think we're 250, 260 already.
Oh
Yeah.
my, because I thought you were around in 100 around June.
No, we rounded 100 in, I think, April of this year.
Oh my gosh.
Yeah.
Okay, so guys,
Yeah.
I mean, listen, the number of mortgage pros out there that are hitting hundreds of transactions in 1 year's time is a very, very small number.
Right.
And those that are actually specializing in real estate investing is an even smaller number. So again, I think working with experience and getting some of the information you need to really get involved in real estate investing, whether it's because of your 10th deal or because it's your first deal, is one of the most important things you can do. Just surround yourself with the right team. So today, Joe, what I wanted to bring in and talk about, and we're going to have a series of trainings with Joe that will touch on some of the most important aspects of the mortgage piece to real estate investing over the next coming weeks and months. But today we want to talk about the 5 guiding principles of getting started in real estate investing. So if this is your first time considering real estate as an avenue to which you can earn residual income and really put yourself on a path of having freedom to choose how you spend your time, this is going to be where you need to start, right?
Absolutely, yeah. We want to give you sort of that basic building block, the bottom of the pyramid of thinking about how, why, what, and build up from there.
Okay. So what would you say is the very, very first principle that needs to be considered as you're getting started in real estate investing?
Sure. Number one, super obvious, but I think so many people miss this. Why do you want to invest in real estate? What's the reason you want to do it? All right. We all watch late night TV or hear the infomercials or have our friends that, oh, my God, they made so much money in real estate. Okay, that's great that we all know somebody that's done that or someone who we've heard about, but what's your reason? Why do you want to do it? Do you want to build passive cash flow? Do you want to replace your job? Do you want to make enough money to pay for your kids to go to college? Do you want to have income to retire? Whatever it is, you really need to understand, you don't want to just become a real estate investor to become a real estate investor. Why do you want to spend time away from your family? Why do you want to spend time, looking at properties, spending time talking to guys like me, talking to your real estate agent? Why do you want to do that? What's the real reason behind it? And what's all that work going to get for you? You have to understand your why. It's the number one thing.
We have a really close mutual friend, Charles Roberts, who's the founding managing broker of Your Castle Real Estate.
Yeah.
And Joe happens to be the in-house mortgage professional for Your Castle Real Estate. Coincidentally, Castle in both of the names, which I think is nothing more
There's
than
no
a coincidence,
affiliation,
right?
it's just a coincidence, yeah.
So keep in mind here that Charles and I did a video not long ago about real estate not being for everybody. And I think that
That's right.
plays true here in this first point, because sometimes the why has nothing to do with real estate at all, right?
That's right.
And that's how it is for me. I love the subject of real estate, but in practice, I'm not a big fan. I don't love going out and exploring a lot of properties anymore. I don't love, the lack of sex appeal when it comes to managing tenants and termites and toilets, the 3 T's of real estate. Many people could argue there's nothing sexy about real estate, right? I mean,
No.
it's one of those things that is not entirely passive. So if you're looking for a passive way of generating a replacement to the income that you're transacting your time for now, maybe real estate's not it, or you better have a great property manager for it, right?
That's right. It's not entirely passive. It's not sexy at all. Nobody wants to be woken up in the middle of the night to go unclog the toilet at your tenant's home. But you know what is sexy about it? Is cashing big checks.
That's right.
And that does happen. That might not happen in your first deal, might not happen on your second, but over time, you start to buy properties, you hold on to them, you accumulate them, you're going to start to make money. And that's when you say, wow, now I see what they were talking about 5 years ago. This is going to get me to my why.
Yeah. It's the get rich slow process, guys.
That's right.
And if you're attracted to the idea of creating wealth, getting rich, as they say, doing it slowly, from my experience, is really the only way it's possible.
I agree.
And you have to chisel away at it piece by piece. But find that motivator. Figure out what your reason is. It's very cliche, I get it, but for me, it's always been about having that freedom to choose how my time is being spent. Real estate has served me very, very well from that perspective, among many other investment choices that I've made. Real estate's just one small piece of mine. I've never been an aggressive real estate investor, but the properties I have today, they pay me a lot, for what I'm required to do, and that has been a process over time of getting to that point. But I agree, you've got to understand what your motivation is, because believe me, I'm incredibly motivated to deal with some of the headaches that come. But it's funny, because I said this on a video several months ago, that one of the single largest aspirin, and my friend Art Vasquez used to say this, aspirin, I'm not sure if you know Art.
I know Art.
Okay,
yeah,
so
great.
Art used to say, the biggest aspirin to the headaches of real estate investing is cash flow.
It's money.
That's right. If
flow.
you're bringing in the cash, you can pay someone else to deal with the headache for you, and that's basically where I've gotten with real estate today. I don't deal with the headaches myself. I get the texts and somebody else handles it. So what would be the second principle of getting started in real estate?
I think you need to decide how much time you're going to spend on it. And what I mean by that is, I don't want to become a real estate investor in the next hour. I don't want to become a real estate investor in the next year, but how much time am I going to spend on a periodic basis? Am I going to spend 5 hours a month? Maybe that means looking at 1 or 2 properties and having 1 closing. Am I going to spend 10 hours a month? Maybe I'm going to manage my own properties. Am I going to spend 40 hours a week? Maybe that means I'm going to be a full-time real estate agent, property manager, and property investor. I think you really need to dial in what's your current job, what's your current status, what's your current family status, do you have time to do it, and do you have time to do it in the way that you want to? If I've got 3 kids, a full-time job, and I coach Little League Baseball, there's no way I'm going to invest another 40 hours a week into becoming a real estate investor. Yeah. So I've got to think about, what can I fit this into? And I'm not trying to get rich quick, I'm trying to get rich slow. So maybe it is 5 hours a month, that's okay. I don't invest a ton of time in my real estate investment and I make money from it, but it's not something I'm looking to make my full-time job. Right. It's an ancillary income. And so I really think, along with your why, how much time? Because that's really going to, direct you.
And are you a supporter primarily of long-term buy and hold real estate investing?
I am 100%. I know a lot of guys that do fix and flip investing. I know a lot of people that make money with property development, retail development. I don't know a ton about it. What I do know is everyone that I know that's ever bought a property and held it for a very long time has made money off of it.
Yeah, because I'm obviously that's the direction that I personally choose to go. I think that it helps mitigate a lot of the risk that comes with some of the shorter term windfalls that you can get from doing fixing and flipping, or even development. You get caught on the back end of an economy that's turning, and I've seen it happen through the last downturn. The thing about Joe and I is we've both been involved with the community since the last bull market and through the last bear market and back up through the next bull market, and I'm sure we'll be facing the next bear market together as well.
That's right.
So we've seen what it kind of requires to prevent some of those significant show-stopping stumbling blocks that can happen, and it'll set you back. I mean, I'm not talking months, I'm talking years. Yep. Many of the people that were in our coaching program at the time were in a position to overcome a lot of that much more easily, but we saw the impact. We saw it spread really, really wide, and you've got to be prepared for what's to come, because believe me, this is not that was not the last sales price we're going to see on real estate. And if you position yourself smart enough, you're going to be somebody that can be a part of that huge transfer of wealth that's expected the next time the market changes, right?
There will be another downturn. I guarantee it. I make very few guarantees. I guarantee there will be another downturn. I just don't know when it's going to be or how bad it's going to be, but you better make sure you're ready for it.
Yeah, that's exactly right. Okay, so what's the third principle?
So the third principle is, how much money are you planning to invest to get started? All right, maybe you've got $100. All right, maybe that's not enough to buy real estate, but maybe that's enough to buy a book on real estate and start saving up. Maybe you have $10,000, so maybe that's enough that you can partner with somebody. Maybe you have $100,000. Maybe I can buy 1 property, 2 properties, 3 properties. Maybe I've got a 401k that's been languishing from an old job, and I could take money out of that and invest $25,000 into a property. You've got to understand what's your starting point. All right, we talked about our why, we talked about how much time. Now we need to know how much money. How much money are you planning to start with? And if it's 0, doesn't mean you can't get there, just might take you longer. If I'm starting with $1 million, yeah, I'm going to get there, and maybe I'm going to get there sooner. So your starting point is going to be different for everyone, but you really need to figure that point out, is how much money am I prepared to invest? And let me talk about this. How much money is your spouse prepared to invest? Because just because one person wants to do it, you need to have the other person on the same page. Maybe I want to invest $1 million. Maybe my wife wants to invest $5,000. That's a big disparity. We should probably talk about that before we go and look at properties.
You got a good point, and I would also offer that point is also applicable in the second and first principles in this conversation as well. Make sure that you guys have aligning longer term objectives as well. And if not, there has to be some form of compromise where you're each willing to meet somewhere in the middle, wherever that is.
Absolutely.
Typically, the more conservative of the two wins out. That's been my experience.
Yep.
So for you, the ambitious, this might be a little bit tricky, but you've got to remember that what we're discussing is terrifying to a lot of people.
Absolutely.
This is not something that you're going to come into this and it's going to be all, daisies and rainbows. It is going to be uncomfortable throughout a lot of it, especially in your first transaction, your second transaction, and so forth. It gets easier and easier over time, but I have yet to go through any type of real estate transaction where I didn't learn a tremendous amount during that, because I didn't know what I was up against until we were able to kind of reflect back on it after the fact. And so listen guys, if you're here looking for a comfortable way of creating wealth, real estate is not it.
No, it's not comfortable, but if you get out of your comfort zone, you can make a lot of money doing it.
It's exactly right, and that falls in line with everything we talk about on this channel. It's scary to be in an uncomfortable position. It's scary to face things that you're unfamiliar with. Real estate's no exception to that, but everything virtually on this channel from the standpoint of banking a better way involves that. Now I want to talk quickly on this point because you talk about how much money somebody needs. And what I've always been a big fan of is finding ways of creating wealth that didn't require much, if any, of my own money at all. Right? And so we talk about the concept of debt weapons.
And love it.
And Joe and I have had this conversation, and I wanted to come and just kind of verify with you some of the thoughts that our members have taken advantage of and how this might look as we move into the future. One of the platforms that we relied on is utilizing the bank's money in order to help kind of leapfrog our progress. And part of that is being able to borrow parts of either the down payment or the fix-up costs or vacancy expenses, so emergency reserves are covered. And we even borrowed from our debt weapons to purchase a healthy sum of crypto just 2 weeks ago, and we're up 70 some odd percent already on that investment. And again, arguing that that's actually an infinite ROI because it wasn't
your own money. Right.
So Joe and I have had this conversation, and I think it's important to understand that there are a number of different debt weapon tools that can be drawn against in order to create funds for down payment money and fix-up costs. But for the most part, these dollars will generally need to be seasoned, right?
Correct.
And the seasoning process, from my understanding, is usually a 2-month window, right?
2 months,
so usually 60 days. Are there certain investors or lenders that require more than that, like 90 days?
There are,
time to time?
Yeah, and this is where it comes back to what you mentioned earlier, that you want to work with a lender that understands real estate investing and understands the rules and guidelines and has appropriate rules and guidelines to meet the needs of real estate investors. Some lenders do require 90, 120 days worth of seasoning.
So explain what seasoning is so that they understand.
So let's just say you want to buy a property, and let's just say it's a $100,000 home, and you're going to put $20,000 down. And I'm going to give you a loan for $80,000, and this other $20,000, you've got $5,000 of your own money. You're going to take $5,000 from a life insurance policy that you have, and then you're going to advance a $10,000 credit card. All right, you can't just show up on the day of the closing and say, "Okay, Joe, here's my $10,000 draft check for my credit card." That's not going to work. That's borrowed money. But here's what you can do. You can take $10,000 off of that credit card. You can put it into your savings account. You let it sit there for 2 months. Then you bring me 2 monthly bank statements showing that you have at least $10,000 in your bank account. Guess what? I'm not going to go back and look at the prior month's statement to see where that money came from. That's now your money. We're going to factor in, of course, the payment on that credit card. So that $10,000 maybe has a $150 a month payment. We've got to make sure you can afford that payment and you can afford the payment on my new loan, but we're going to give you credit for that rental property income that you're going to be getting. So by putting that money in the bank, that money seasons, you own it over a certain period of time, and we're not looking more than 60 days back for where you got that.
Right, the 60-day window is where they're gathering the bank statements to source the money. So if a deposit was randomly showing up during that 2-month period of time, the lenders are going to want to know where that money came from. Right.
Yeah.
So beyond that 60 or in rare cases 90 or 120 days, they're not sourcing the dollars. It literally becomes, it's considered your money at that point.
That's right.
Let me hypothesize another circumstance.
Yeah.
Let's say, for example, I have debt weapons that don't show up on my credit report.
Okay.
So let's say I've got a revolving business credit account that I can pull against, pay back, very much like a home equity line of credit, but unsecured.
Unsecured, okay.
And I draw all $50,000 of that, and I season it over 60 days into my bank. Arguably, I have $50,000 that when my credit is pulled is invisible to view, correct?
That's correct.
So it does not, in that case, if you have current expenses that are currently something you're responsible for, but that don't report to your personal credit report, it is not factored into your debt to income ratio, correct?
That's correct.
So if you had, say, personal loans from family, that would be something that potentially would qualify as well, as long as it was seasoned for at least the 60-day point.
That's correct.
Now, talk a little bit about the home equity line of credit advantage, if you will, because it's also my understanding that home equity lines of credit are considered eligible forms of down payment.
Right.
Without the seasoning, you can literally just write it off of the account.
That's exactly right. So the difference here, we used our example earlier on a credit card. That's unsecured borrowed funds. You can't use unsecured borrowed funds for a down payment. So that's why you take that money out, deposit it in the bank, let it season. Now HELOC, home equity line of credit, that's basically like a big credit card tied to your house. All right, you can advance that and you can use that money the very next day to buy a property. And the reason that's different is because it's secured borrowed funds. Yeah. It's money that you're borrowing against an asset that you already have, your home. All right, so you've owned that home for greater than 60 days, which is why that money's already seasoned. It's not necessarily liquid, but you've taken it out and you've liquidated that equity, and now you can use it for your $20,000 down on that new loan that I'm giving you for that $100,000 property. So that's a great opportunity with a HELOC.
I like that. Okay, so the fourth principle along this discussion point is timeline, right? You got to kind of try and reverse engineer your timeline, just thinking with the end in mind again.
That's right, yeah. If we think that, hey, you know what, I want to retire in 10 years and I need $5,000 a month in passive income in order to retire, how many properties do I need to have that are paid off free and clear? How many properties do I need to buy today, tomorrow, next year, next month, etc., in order to get to that cash flow goal that I need? Maybe it's 10 years. Maybe I want to send my children to college in 20 years. So maybe I don't need to buy as many properties because I have a longer time for those properties to mature and pay off. Or maybe I need to retire in 5 years and I need to invest more money today. So you really need to think about that. With my why, my end goal, when's that going to happen? All right, I need $20,000 of retirement income next month. Maybe it's too late, right? You need to think about that, and you need to talk with somebody like Matt and his coaches over at VIP Financial to help walk you through that and figure out what's the best way to get you to that end goal. Yeah, and boy, you know, for us, at no point is your cash flow going to stop mattering. Right. So you're always going to need it.
So the fifth point in this collection of principles really boils down to how are you going to exit this, right? Because if you're going to exit and sell off properties, you're still going to have to worry about how your income is being generated. You know, you're going to put $2 million into a bank account and just live off of it every day until you pass away? Maybe. But really, what is the game plan from that point forward? So if I'm understanding correctly, the fifth principle here is going to be something along the lines of how do we get out?
Yeah, absolutely. I encourage every investor to think about exit strategy. I learned this, my first day in banking, where we were approving a loan for a guy that wanted to buy a new business, and the banker that I worked for, he asked the guy, he said, "What's your exit strategy?" The guy said, "Well, I'm buying the business. I'm not trying to get out." He said, "Well, unless you're planning to die with this business, I want to know how you're going to get out at some point in the future." And it was very eye-opening for me. I said, wow, no matter what you're investing in, no matter what you're buying, you've got to have a plan for what you're going to do when you reach the end. And so I think you should think about that with every property. You're buying this condo today. Do you plan to sell it in 3 years, 5 years, 10 years? If you plan to sell it, is it in a desirable area where you're going to have a market for people that want to buy it? Maybe you want to keep this property for 30 years. Okay, that's fine. Do you plan to die with it? Are you going to give it to your heirs? Are your heirs interested in real estate? Maybe you need to write up your will that, you know what, my property is going to be liquidated and you're going to give my children cash. Or maybe you're going to give half the cash to this kid and half of the properties to this kid. What's your exit strategy? What's going to happen when you reach the end?
So I guess what I'm taking away from this discussion is, again, thinking about the beginning of the end first, and then building your plan with the end in mind applies here like it applies in many other areas of life.
Absolutely.
And so, guys, the more you can collect a step-by-step game plan before you even dive in and get started, the better off things are going to unfold for you. I think it all starts with having the conversations and getting started in real estate. If you're really going through the actual proactive steps, once you've gone through these 5 principles, very early in those steps, you're going to have to go out and get pre-qualified. And you're going to do that through somebody like Joe. So we're going to put some contact information in the description below, including our email address. Contact us at vipfinancialeducation.com. In the subject line, go ahead and put mortgage if you'd like to have any conversations with Joe or his team. Joe is licensed in Colorado and a couple other areas. However, he has connections of highly vetted, very successful experts around the country. So there shouldn't be a state that we can't help. If you guys do have any mortgage needs, please go ahead and shoot us an email to the Contact Us at VIP Financial Education email address. Throw mortgage in the subject line. Beyond that, guys, I want to thank you for joining us on today's training. If you're new to the channel, this channel is all about how to bank a better way. How do you hack the system in order to get yourself into a financial position that you want to be in a much shorter period of time and spend a lot less money getting there. Right. People like Joe are here to help you do that. Guys, I know this video has gone a little bit long, so I'm gonna go ahead and share some of Joe's credentials with you in a subsequent video. Joe and I are actually gonna be giving you your own investment property analysis worksheet, one of the slickest tools I've seen used in investment real estate since starting myself.
Yeah. I use it every day.
I mean, this thing is slick. Guys, people love this. Joe is pursued heavily for this resource, and he's been generous enough to share it here with you, our audience. And so I want to thank you for that.
Yep.
So we're going to have Joe back. What he's going to do on subsequent video is go ahead and review that analysis worksheet. We'll go ahead and kind of go through some of his background on that video, so be on the lookout for it. In the meantime, make sure you turn on the bell notifications when you subscribe to be alerted every time new videos like that are released. Also, if you like videos like this where we're talking about various lending tools like debt weapons and mortgages, please make sure and drop a thumbs up on this video. In the meantime, guys, I just want to say thank you so much for checking out another video here on the VIP Financial Ed channel. And until we see you on the next one, make it a great day.
Thanks,
Take care. Thanks, Joe.